Hey there, and welcome to this explainer. Let's talk about cash. I mean, if you open up your wallet right now, you're probably going to see a few bills and think, yep, that's cash. Simple. And in daily life, it really is. But in corporate finance and accounting, well, the concept of cash is surprisingly complex and heavily regulated. Today, we're focusing on Chapter 1 of our source material, diving deep into intermediate accounting to really demystify cash and cash equivalents. We are going to completely separate the everyday myths from the strict accounting realities. But hey, before we dive into the heavy theory, I've got a pop quiz for you, straight out of problem 1-1 of our text. I want to disrupt your everyday expectations right off the bat. So, pop quiz. Which of the following is usually considered strictly as cash? Is it A, a certificate of deposit, B, a checking account, C, a money market certificate, or D, a postdated check? Go ahead and lock that answer in your head. By the end of this explainer, not only are you going to know the correct answer, but you'll understand the exact financial logic behind why the others just don't make the cut. All right, here's our roadmap for this explainer. First, defining corporate cash. Second, what are cash equivalents? Third, handling bank overdrafts. Fourth, understanding compensating balances. And finally, managing petty cash funds. So, our mission checklist today comes right out of the Chapter 1 Technical Knowledge Objectives. We're going to define cash and cash equivalents, nail down exactly what items fit those buckets, and figure out the accounting for petty cash. Ready? Let's jump in.
Section 1. Defining corporate cash.
Okay, the absolute crucial point here is the definition. In the accounting world, cash is not just physical money. It's strictly defined as unrestricted, liquid assets that are readily available for use in current operations. Now, I really want you to mentally highlight that word, unrestricted, because if money is locked away or tied up in some legal agreement where you can't just use it today to pay a bill or buy inventory, well, it might be an asset, sure, but it is not classified as cash. Availability is literally everything. So, what definitely makes the cut? Standard inclusions are currency on hand, checking account balances, and savings account balances. These are your true unrestricted cash items. And boom, right there, we just solved our pop quiz. The correct answer was B, check-in account. Now you might be wondering, why not a post-dated check? Well, a post-dated check has a time restriction on it. You literally can't cash it today. It completely fails that readily available test, so it gets tossed right out of the cash category and into receivables. Moving right along, Section 2. What are cash equivalents? Now, if an asset isn't quite cash, but it's, incredibly close, it lands right here. Cash equivalents are defined as short-term, highly liquid investments easily convertible to known amounts of cash. The big rule of thumb here: to qualify as a cash equivalent, an investment has to be super safe and very near its maturity date, usually an original maturity of 3 months or less. Some classic textbook examples would be time deposits, money market instruments, and treasury bills. Remember our pop quiz from earlier? The money market certificate and certificate of deposit were both options. Well, this totally clears up why they aren't strictly cash. They're investments. Yes, they are incredibly safe and liquid, making them cash equivalents, but they are not raw cash. And let me tell you, that distinction matters a lot on a formal balance sheet. All right, let's introduce a little friction. Section 3, handling bank overdrafts. Think about your personal life for a second. If your checking account goes negative, you probably just think of it as a negative balance you need to fix ASAP. But corporate accounting? Oh, it does not like negative assets. A standard positive bank balance is obviously recorded as a current asset. But the exact second that account drops below zero and turns into a bank overdraft, its entire fundamental nature changes. It's no longer an asset. It magically transforms into a current liability. You owe the bank money now. It's a classic case where everyday logic totally clashes with strict financial reporting. And here is a huge gotcha rule from the text that you really need to remember. Overdrafts cannot just be offset against positive balances in other bank accounts. Think about it. If a company has $1 million in Bank A, but they're overdrawn by $10,000 in Bank B, they can't just report a net asset of $990,000. No way. They have to report a $1 million asset and a separate $10,000 current liability. Unless the accounts are at the exact same bank and are part of a highly specific integrated cash management system where offsetting is legally allowed, you absolutely cannot mix and match them. Let's look at another tricky scenario. Section 4, understanding compensating balances. So what is a compensating balance? The text defines it exactly as a minimum deposit required to be maintained in connection with a borrowing arrangement. Basically, it's like the bank gives a company a loan, but then turns around and says, hey, you have to always keep at least $50,000 in your checking account with us. It acts as a safety buffer for the bank, but for the company, that $50,000 is absolutely no longer unrestricted. Sorting out the complexities of these balances really just boils down to legal restrictions. If a compensating balance is not legally restricted from withdrawal, it just stays classified as part of your regular cash and cash equivalents. Easy enough. But if it is legally restricted, the whole game changes. Is it related to a short-term loan? Then it gets stripped right out of cash and reported separately as a current asset. What if it's tied to a long-term loan? Well, then it gets moved completely out of the current asset section altogether and classified as a non-current investment. The legal fine print literally dictates exactly where that money lives on the financial statements. Finally, let's zoom in a bit. Section 5, Managing Petty Cash Funds. Our text pits two completely distinct methods of petty cash management head-to-head. First up, we've got the imprest fund system. This is the strict, highly controlled approach. Basically, the fund is set at a fixed balance, let's say $500. Whenever money is spent, you keep the receipts. Then, at the end of the month, the fund is replenished for the exact amount of those receipts, bringing it right back up to that $500 mark. On the flip side is the fluctuating fund. It's way more relaxed. Checks are drawn to replenish the fund just based on estimated needs, which means the actual balance is going to fluctuate up and down over time. Now, in corporate accounting, the imprest system is vastly preferred. Why? Because it enforces strict accountability. We have covered a lot of ground in this explainer today, turning some heavy accounting theory from Chapter 1 into really clear operational guidelines. But before we wrap up, I want to leave you with a provocative question to really lock in our myth versus reality theme. Imagine this. You look at a company's bank statement and you see millions of dollars. But upon closer inspection, you realize every single cent of it is legally restricted as a compensating balance for a massive long-term loan. So, are they actually cash rich? Well, according to the strict rules of accounting we just went over, the answer is absolutely no. They might have a ton of money, but they have zero actual cash. It completely changes how you read a balance sheet. Just keep that in your back pocket the next time you look at a company's financials. Thanks so much for joining me in this explainer, and keep focused on those details.